You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 24th of June 2024, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing DS Smith, Britvic, Whitbread, Hargreaves Lansdown, Ashtead, and our US company of the week is Wix. John, do you want to start us off with DS Smith?
Yes, so DS Smith had their full year results out, with full year revenue falling by 16% to £6.8 billion, ignoring the effect of exchange rates, and weak demand and lower prices impacted the overall performance. Underlying operating profit fell by 18% to £701 million, in line with guidance. Like-for-like volumes fell 2% over the year, but returned to growth in the final quarter as customers increased the promotional activity and stock levels. Positive trends have continued into the new year, including improved pricing. The benefits of this are expected to be seen in the second half. And there was a free cash outflow of £175 million compared to an inflow of £354 million in the prior year. And net debt rose from 1.6 billion to 2.2 billion pounds. A final dividend of 12 pence a share was announced, taking the total for the year to 18p. And the shares were up 1% following the results. In terms of valuation, DS Smith has a market cap of £5 billion and a forward price to earnings ratio of 10.5, compared with a 10-year average of 11.5. And its prospective dividend yield is 5.1%. I think these results were disappointing. They had been broadly in line with what had been expected. I mean, since we've been covering it, I think we've thought it has been a quality business. There is cyclicality to it, although it is on the back of the growth trend, which is, largely e-commerce, providing a lot of the corrugated boxing for companies like Amazon. It's been very difficult when it's come to energy prices, and I know we've talked a lot about how much they're producing themselves and the volatility that's associated with that, how much they manage and how much they sort of outsource. And a lot of the news has been dominated with Mondi now being out of the race and DS Smith looking to press on and merge with the US-based International Paper Company. That's not a company I'm particularly familiar with, and I think really since that has all happened, I moved away from following it really. But I think in the longer term, quality business, trading at quite a modest valuation, which has obviously led to the interest in it. But sadly, I think it's one that we're not going to be covering for much longer, so probably wouldn't be diving into any more depth with it really. Sam, what are your thoughts on these results and the speculation with the US International Paper Company Group?
Is that what it's called?
Yeah, so it's International Paper Company.
Oh, right. It's not the
innovative.
Most exciting name, but it does what it says on the tin, doesn't it? I mean, it would have been nicer if Mondi had bought them, just because we could have carried on covering it and it would have stayed in the UK. But it is what it is. I think in terms of these results, they're pretty poor. They're quite disappointing. They are what was expected. We knew it was a cyclical business, so I don't think there's any surprises. The yield's pretty good, but if they're probably going to get, I suppose if they get merged, you'd hold on to your shares and you get shares in something else. But then I don't know anything about the company that's purchasing it, but I know DS Smith and like it, but I don't think I'd be interested in covering the other one. If it's a US listed paper company, I don't see when we'd ever cover it. So yeah, I agree. It probably will be the last time we cover it, unfortunately, which is a shame because it is a good business. And I don't think either of us have ever pulled the trigger, but I think it's been on our watch lists for a few years, and it's been a good company to cover. So yeah, it's a shame.
So International Paper Company, first listed in 1962, and it's got a market cap of about nearly $16.5 billion. So significantly bigger, but that's all I know about it.
Although it is a merger and you might get shares in some joint entity instead, you've got to really like the other one if that's contributing sort of 2/3 to 3/4 of it. Should we move on to another business that we'll be covering for much longer?
Yeah, well, I am very sorry about this. So Britvic, I mean, we were saying how good the results have been lately, and that it's actually quite a reasonable valuation. And then what happens next?
Yeah, someone's obviously been listening to us. Yeah, so Britvic, who are well known for their soft drinks, really. So they've got the Pepsi license in the UK until 2040. They also have a lot of other brands, so Robinson's, Fruit Shoot, J2O. They really are quite a dominant business in UK drink. There's been 2 offers rejected from Carlsberg to take them over. However, it looks like they're being rejected on the basis of price rather than because they don't want to sell. So it looks like this one is going. So there's a third offer expected to come in from Carlsberg. They've had to speak to Pepsi because Pepsi have a change of control clause where they, I think, basically could have changed who they were distributing with in the UK if they didn't like the deal, but they don't have an issue with it. So that's got the green light. Carlsberg disclosed last week that they've made 2 takeover bids for Britvic, and the latest one was £12.50 per share, which was rejected. And the Britvic board said that they felt it significantly undervalued its prospects, but that they would consider any future proposal on its merits. So was it £12.50 rejected? So I find this quite interesting. So it's actually currently trading at £11.73. And the new offer that is expected to come in is expected to be closer to £14 a share. Yes, it's about 15% off the price that is expected to come in at. So if you were quite confident this was going to go ahead, you could do quite well on it. But then that is with the caveat that if this doesn't go through, it's probably going to go back down to where it was. So that's the risk you're taking. But I just find it interesting that the market's obviously not that confident that this £14 bid is coming in. Although if they've gotten permission from Pepsi, that suggests that Britvic maybe are. Yeah, so it'd be interesting to see. We probably will cover this again because this one's still in the works and it could take a while before these things complete. But looks like it is going. They seem to be quite happy to sell to Carlsberg. I don't know what the ownership of Carlsberg is.
So yeah, listed in Denmark, and it's got a market cap. Don't know how much 121 billion Danish kroner amounts to.
Probably not 1 for 1, I imagine. 1 kroner is 11 pence. So just divide it by 9, basically. What's that, sort of 10 to 15 billion? So probably about 15 billion, something like that. So it's bigger than Britvic, but it's not massively bigger. And this is quite a sizable acquisition for Carlsberg, but I do think Britvic's a good acquisition for anyone. I do think it's a very good company. But yeah, it's a shame because it is a company that I've liked for a number of years. I know the last couple until more recently we've been maybe a bit hotter on AG Bar, but it will be a shame to see this one go as well, which is a bit of a theme of the show, actually. Do you have any comments, John?
No, that's right. It is sad, and with quite a lot of these, they have seemed, when we've discussed them, at very, very fair valuations. That's probably putting it mildly. So in some ways, it's not surprising.
If anything, it's surprising probably how few of these we've seen since we've done the show. I know we do get one occasionally, but given how cheap the UK market is, in my opinion, with still some quality companies there, you'd be surprised there's not been more of it, or I am. But
and it's all not all happening now, but there are quite a few that have been happening more recently. So
yeah, they have. Should we move on to Whitbread?
Yes, so Whitbread, we've been covering it for a few years now, and it's one that has been, well, it'd be fair to say it's been growing on us a lot. Anyway, for anyone who doesn't know or hasn't listened before, it's a business that over the years has owned huge amounts of things on the high street and used to own Costa. It sold that a few years ago to Coke, and that was one of the very big deals. And then after that, it was left predominantly with Premier Inn. Does have the Harvester, but the main brand is Premier Inn. And I know we've talked about this a lot. We'd traditionally, I think, felt that it had been saturated in the UK market. And where does it go from there? Obviously had a very difficult time during COVID, took on a lot of debt. We wondered what the future of the business was at that stage. And now it's got back on track in the UK, and it's got some quite exciting growth plans that are being unfolded and so far are working very well in the German market. So anyway, they had a first quarter trading statement out with revenues up 1% to £739 million, recovering from a 1% fall in the first 7 weeks of the year. On a like-for-like basis, UK accommodation fell by 2%, reflecting both lower occupancy and room rates, particularly in London. Food and beverage sales fell 1%, with strong in-hotel breakfast sales offset by softer trading at some of its branded restaurants. But in Germany, sales were up 5%, helped by a 3.6% increase in average room rates, and the division is on track to break even later in this year. Whitbread remains confident in the full-year outlook and has recently seen more encouraging trading in the UK, and shares were up 3% on the news. In terms of valuation, the group has a market cap of £5.3 billion and trades at 1.5 times forward earnings with a 10-year average of 2.1, and it has a prospective dividend yield of 3.4%. I think these results, they were okay. It had really recovered last year. So I suppose it in that sense, it was on the background of very strong trading. I think what it is doing and how it is running the business now in terms of paying down the debt and expanding in Germany, it does have a clear growth strategy there. And from a valuation perspective, is very cheap. I don't know whether it would be one that I would be going for. I think when we've covered IHG and the capital light model that they operate, I'd probably be more tempted by that. But I think what the directors are doing is starting to pay dividends with Whitbread, and from where it was just a few years ago, they have been doing really very well. I think it'd be an interesting one to watch, but it's probably not one for me right now. Sam, what are your thoughts on the Q1 results from Whitbread? Or Q1 trading statement, I should say.
Not as good as what we've started to become used to, especially with such a capital intensive business. I think it just can't grow as quickly as we've gotten used to seeing. But yeah, it looks like it's consolidating a bit. I wouldn't have a huge issue with it if I was a shareholder, because the UK is basically flat, which is pretty saturated. So I wouldn't be that surprised about that. But the Germany sales up 5% is encouraging. I'd like to see that up higher, and it has been very recently. So I wouldn't be too concerned, again, if they're just consolidating. We've covered before, that the German hotels market is a lot more fragmented than the UK, and I don't see any obvious reason why it should be. So it does seem like there is a bit of a gap in the market for someone like Premier Inn to go in, and so far it seems to be working quite well. So if I was a shareholder, I'd be quite happy with this. Just been really impressive the last couple of results, whereas this isn't quite there. It's more like they've had to consolidate what they've done in the last sort of 12 months or so. But I think at a P of 14, it's pretty fair, especially considering that there probably is quite a large opportunity in Germany.
Yeah, I think what you're saying has been reflected in the share price as well. So year to date, it's down about 18%. So I think it has, things have been a bit more tempered.
I think it's pretty fair. And if I was a shareholder, I certainly wouldn't sell on the back of these results, because it seems like the strategy is working. And I think management have done an excellent job with this, considering where they were in sort of the depths of COVID.
Okay, then. On to, do you still own it, Sam? A stock that you once held?
Sold it last week, actually.
Oh.
So I sold it. So we'll get into the reason why. But Hargreaves Lansdown have also been subject to a takeover offer. So this one's from private equity firms that would value the site at 5.4 billion, and Hargreaves Lansdown said it's willing to recommend unanimously the takeover offer. So I think it's still going to be put to a shareholders vote, but a consortium of private equity funds led by CVC Capital Partners, they'd previously had an offer rejected, but they've come back with £11.40 a share. So currently the share price is bang on £11.40. I think I sold it at about £11.20 or something, but I just thought it's had a pretty torrid time in that it's down it's down 40% in the last 5 years. It's up a bit more in the last 2 years, but that's because it dropped so low. But it had been trading at sort of £25 a share-ish, whereas it's at £11.40 now. I was down about 25% on my shares when I sold them, but I had held it for probably about 4 years with probably a 4% dividend a year. So it wasn't too bad a loss. My issue was it looked like it looked like they were going to accept the offer, and it was so close. It was within 1% of it when I sold the offer price, which seems like the market's pretty confident it's going to happen. So I don't really see a scenario where it gets rejected and someone comes back with a higher offer. So I just thought I may as well just take the money now, because there is still that small risk that it gets rejected and just tumbles back down to where it was. But we said it before when we've covered it. I know you've not been as keen on the industry, or I'm not that keen on the industry anymore either, but it had gotten to a point where it was actually quite cheap. It was at about 10 times earnings, 11 times earnings for a while. Now, with these takeover offers, it's pushed it up to about 16 and a half. I just thought I'm getting what the takeover offer is, and it looks like the takeover offer is going to be accepted. So I just didn't see any point in holding on to it. So yeah, I sold mine last week. Any comments, John?
No, I think it's fair enough. But I think it also does reflect that whilst it may be an industry that I wasn't particularly keen on, it was a very cheap valuation.
Yeah, I do wonder though how it will go with the shareholders, because there must be a lot of shareholders that are still underwater on this. There can't be many selling for a profit. When you look at the share price for the last 10 years, it's only really since 2021 that it started trading below £10 a share. That never really happened since 2014. And there will be shareholders that bought it £20 a share or £15 a share. I think I was probably about £14 a share, but they are just being forced to take a loss on this.
Is it Mr. Hargreaves who has 20%? He has a pretty chunky stake and he's going for it, I think. So
yeah, so it looks very likely to go through. So yeah, I just didn't see any point in holding on to it. But again, a shame because, well, it's quite an interesting stock to cover. Market leader, good industry. Again, it'll be a shame that we can't cover it anymore.
Yeah, no, absolutely. It will be a shame.
Should we move on to Ashtead?
Yes, we'll move on to Ashtead. So we've covered it a few times on the show, but anyway, they had their full year results out last week, with Ashtead reporting full year revenue growth of 12%, ignoring currency moves, to $10.9 billion, which is up 7% in the final quarter. And underlying operating profit rose by 5% to $2.8 billion. And the results in the final quarter were slightly worse than expected. Free cash flow fell from $531 million to $216 million, and that was mainly due to higher capital expenditure. Net debt rose by $1.7 billion to $10.7 billion. And the group remains on track for rental revenue to grow between 5 and 8% for the new year, and to deliver $1.2 billion of free cash flow. And management have said end markets in the US remain robust. The board has proposed a final dividend of 89.25 cents per share, for a total of 105 cents for the full year. And the shares were down 4.3% on early trading. In terms of valuation, Ashtead has a market cap of £24 billion and trades at forward price to earnings of just under 17, compared with a 10-year average of 15.1, and it has a prospective dividend yield of 1.6%. I mean, I thought these results were pretty good. I guess it's just become what the market is expecting, and hence the disappointment there. But I think it seems to be a very well-run business and has really been doing well in the States. I think the industry that it operates in is perhaps not that exciting, but on the back of a strong US economy, it really has been delivering, and it seems to be making a success in the States. It's interesting as well that it's specialising a bit more in some businesses. So some of scaffolding, flooring, air conditioning, they're pressing and developing inroads into those markets. So it is a little bit more niche, because with a lot of the building stuff, it's very cyclical, whereas some of those things are less cyclical. So I think that's probably a very sensible strategy. And I guess from a valuation perspective, it's certainly not cheap, but where we seem to be in the cycle, it's continuing to put up numbers like this. Does have a significant amount of debt on the balance sheet, so that is a bit of a concern, but I think overall you could do a lot worse, but you'd probably have to be prepared for a bit of a bumpy ride just with the cyclical nature of this business. Wouldn't be one for me, but the results that it's been putting up, you can't argue too much with. Sam, what are your thoughts on Ashtead?
Pretty similar. I think the results are a good set of results, but I just don't see a scenario where it's growing at 12% a year. And like I say, we've covered it a few times, and it doesn't grow 12% every year. So I think 17 times earnings seems quite expensive for it. I don't think I'd ever be interested in it anyway, just because of the industry. I think it's a very good operator, but it's just such a capital intensive industry because you've got to buy all the equipment to lease it out to everyone. So not a stock I'd ever be interested in, but a well-run business.
Okay, fair enough. On to another one. Well, in fact, it's the only one of these that you do own.
I sold it.
Oh, gosh. Oh,
I know. So I sold it to buy a new car.
Oh, gosh. Okay.
So that new car is quite a bit more expensive than I thought at the time. So Wix, they are the online platform that allow you to create websites. They have come out with their Q1 results, and total revenue for the quarter was $419 million, and all these figures will be in dollars, up 12% year over year. Creative subscriptions revenue was $303 million, up 9% year over year, and creative subscriptions annual recurring revenue increased to $1.24 billion at the end of the quarter, up 10%. Business solutions revenue in the first quarter was $115 million, up 20%, and transaction revenue was up 17% to $49.5 million. Partners revenue was up 33% to $138 million, and total bookings were up 10% to $457 million. Total gross margin on a GAAP basis was 67%, and that was split by creative subscriptions and gross margin of 82% and business solutions of 29%. GAAP net income for the first quarter was $24 million, or 43 cents a share, and 41 cents per diluted share. Net cash provided by operating activities for the first quarter was $113 million, while CapEx totaled $8.1 million, leading to free cash flow of $105.7 million. Excluding capital expenditure and other expenses associated with the build-out of the new corporate headquarters, free cash flow for the quarter would have been 26% of revenue. $300 million of share repurchases were announced in February, and they've been completed, which represent 2.4 million shares, an average price of $124.91. And the total employee count at the end of the quarter was down 1% to 5,235. They've also increased the outlook, and they're expecting full year bookings to be up 12 to 14%, and bookings in the second half to accelerate to 16% at the high end of the guidance range, as well as full year revenue outlook of 11 to 13% growth. In terms of the valuation, the business trades at a market cap of $8.8 billion, has a PE ratio of 136. However, the price to free cash flow is 33, and that's quite heavily weighted towards this most recent quarter, which had 105 million. So in the past 12 months, the free cash flow is 262 million. So it would actually be a lot lower than 33 if they're going to start churning out that kind of free cash flow, which they could do. They've only really switched to profitability and free cash flow in the last couple of years, but year ended December 22, the free cash flow negative of 33 million. It then swung to 182 million to December 23. In the trailing 12 months, it's 262 million, but only one quarter of that is actually been added on. So you can see it's shaping up for a very, very good year. And frustratingly, that is reflected in the share price.
I was going to say, what was the date when did you roughly sell it? Oh my goodness, Sam. So April, do you know, early April?
I think so.
Okay. It's not so bad if it's early April. I think the shares are up about 15%. I mean, it's very easy to look back and to look at a graph, but I think if you sold it in early May, it would have been worse.
One sec, I'll check my bank. So I think I sold around the 10th of April.
Okay, so if you sold on the 10th of April, let's have a look.
So about 130?
Yeah, so about 20. You'd be up if you'd held about 21%. It could have been as much of the results, things about 35. Year to date, it's about 35%, up about 35%.
That's life. I think I did actually have a small gain on it, but we're talking, I think it was something like 5% or something.
Yeah.
So, and I held it for years. So I bought it around 100, probably around 130, 104, well, probably 130-ish.
Yeah.
And I rode it all the way down to, I think it went below 60 at one point. So I was down over 50%. So I was actually quite pleased when I sold it and got my money back. But obviously, as soon as I did that, that was clearly the catalyst for the improved business performance, as it often is. But
As it often is,
I think if I had to choose what I would have sold, and I know I literally could choose, but part of the reason I sold Wix, because I still really liked it. I still do. But at the time I sold it, I really liked Wix. But it's in my Halifax share dealing account, and I've only got 2 shares in there. So I've got Wix and I've got Fiverr, or I had Wix and I've got Fiverr. And the only reason they're in there is because Hargreaves Lansdown won't let you buy them. So I just thought, well, I didn't want to sort of dip into the Hargreaves account. And I thought, I've got this separate account with 2 shares in that's a bit of an anomaly, really. So I thought, I'll get rid of one of those 2. And the Fiverr was down so much, I couldn't buy a car with that. So it was Wix by process of elimination. But it's a bit frustrating. But if it came back down, it's a business in the future I would like to potentially own again, but that's life. So
that is life.
Anyway, what do you think of the results?
I think the results are very good. I think you make the valuation sound more reasonable, but I suppose it's not. On the surface, you think, bloody hell, what's going on with that? But yeah, I think it looks like a great business. Probably not one for me, but I should add that I did buy. After last week, I did buy some shares in Fiverr and Upwork as well, about the same in both. So yeah, I've got some more US companies which are in the sort of growth category. So I think I'll be sitting back for a little while now.
Yeah, so I think with the valuation as well, it's difficult because if you look at it since it's listed, it's actually been quite up and down. So it did have, in its first full year, it had free cash flow of 129, and then it dropped to 27. But what I find interesting as well is that they've added in the quarter, revenues up 12%, but their biggest expense must be staff, and the employee count's basically flat. So I think that's why the free cash flow is so good, because they've had all this extra revenue, and it's basically just flowed straight through to free cash flow because the expenses haven't changed. So if they can continue doing that and the staff count stays relatively stable, we could be sat here in 6-12 months looking at that free cash flow and comparing it to the year before, and I think it could be triple. It's not ridiculous. If it has another 3 quarters like the one it's had, because it's already added 25% to the free cash flow on the trailing 12 months. And that's basically from 1 extra quarter. So it's not inconceivable that it could double or triple last year's free cash flow. And at that point, at the current valuation, if they can sustain that, it's pretty cheap. And unfortunately, it made my car a bit more expensive if you include the amount which has gone up since. So.
Is the car running well? Do you like the car?
I love the car.
Okay, fantastic.
Would I have loved the extra money? Equally, possibly. But it's always going to be like that when you sell stuff, isn't it?
Absolutely.
I'm sure it'll never get to the level of the Tesla shares.
No, absolutely. Okay, fine. Well, of the companies then, Sam, this week, what would be your top pick and what would come last?
So I think last for me would probably be Ashtead. And that's just because of the industry. I think it is a well-run business, but it's so capital intensive. I just never really want it. I think if you'd asked me a year ago, it would have been Whitbread, but it really has grown on me in the last 12 months with how well it's been run, despite being also a very capital intensive business. I think top, annoyingly, would probably be Wix.
Yeah.
But obviously you've got Ashtead and Whitbread, which I don't really sort of like. But then DS Smith, Britvic and Hargreaves Lansdown, you can't really buy them now. Or if you can, best case scenario is you buy Britvic and get a quick 15%, and that's basically it. Whereas DS Smith, I wouldn't want any shares in the joint venture. So with the Britvic one, actually, so I think you are, is it Britvic or Hargreaves Lansdown? I'll just check, but one of them said that...
It'd probably be Britvic, I'd imagine.
Is that the one where it said that they were allowed to keep the shares in the private equity firm?
Oh, no, it won't be, because it's Carlsberg with Britvic.
Yeah, so there is an option for shareholders to reinvest their stock in the private equity group's unlisted vehicle. So it would be unlisted, but you could have shares in the private equity group. But I don't think I'd really want that because I don't know anything about it. So you could, in theory, continue owning Hargreaves. But yeah, so there's 3 of them that are gone straight away, and the other 2 are very capital intensive. So annoyingly, the one that I would be my top pick would be the one that I sold 2 months ago. What about you, John?
I would if you could still get it, it would be Britvic, but I appreciate that's probably not going to be the case much longer. Possibly Wix. Not the sort of business that I usually go for, but it does look quality. And then last, I'd agree with you, Ashtead. The cyclicality, etc., would put me off it. But I think you could do a lot worse than Whitbread. So yeah, I don't think overall it's a bad week from the choices there.
You wouldn't consider buying Britvic for your quick 15% when that £14 offer comes in?
No. I think it would be very speculative. So no, I wouldn't do that.
But if the offer fell through and you were to get it at the current price, you'd be paying 18 times earnings. So it is a lot more expensive than it was a couple of months. But it's not so expensive that you couldn't hold on to it.
I know, but it's a bit of the sort of anchoring as well, because when we've been covering it, we know what it was trading at. It's very tricky, and there's a lot of psychology in there.
Okay, I think that's everything then.
Brilliant. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.